The more you think about it, the stranger it becomes.
Yes.
But for some reason, as a society, across countries, across religions, across languages, across political systems, maybe this might be the only thing that we all agree on, which is that gold is valuable.
It's setting record high after record high after record high.
Central banks hold more than 35,000 metric tons of gold, and they just keep buying it. Is gold a good investment from today?
Hero or sidekick?
Welcome to the Sidekick podcast, where we uncover the hidden superpowers that drive some of the biggest and fastest growing companies and successful names in the business world. I'm Bryce, and I'm joined by my regular co-host Ren, and we are your sidekicks. Today we are looking forward to our first commodity of the show. It is gold. Ren, how are you going?
I'm very good, Bryce. Very excited for this one. That is right. We are talking about gold.
Yeah.
So in this episode, we're going to talk about how we can think about gold as investors, because the more you think about it, the stranger it becomes.
Yes.
Then we're going to talk about the price, because that's obviously where the investing conversation starts for a lot of people. We're going to talk about the superpowers driving the commodity, and then we're going to close out with whether the superpowers can hold, and then how we can invest in the asset class.
Love it. Well, let's kick off with how strange gold is the more you think about it.
Yeah, because we take it for granted,
Yes.
I think, is the starting point. Things are as they are when you start to learn about investing. In gold, you learn as an asset class is a store of value.
Absolutely.
An inflation hedge, these are the terms that you'll hear. It will preserve your purchasing power.
Yeah.
That's what's in the textbooks. That's what we learn. That's what we hear from financial advisors. And so that's what we internalize. But the more you sort of unpeel that onion and you think about it, it is strange that we've all just come to this consensus. And where we want to start here is talk about history's greatest investor and his dad.
Warren Buffett.
And his dad, Howard Buffett. Now, for people who aren't familiar with Warren Buffett, he bought Berkshire Hathaway in 1965, turned it into his investment company, has delivered about 20% compounded returns in the stock market in that time, and is now, the fourth or fifth richest person in the world.
Yeah.
Has about a $100 billion fortune.
Yeah.
Warren Buffett's dad, Howard, was, I think, a 4-time congressman from Nebraska,
Yep.
but was a gold bug. Would only invest in gold because he was so worried about the devaluation of the US dollar, and he thought that paper money was worthless, and so he wanted to invest in gold because it was hard currency.
Yeah.
Are you hearing some echoes of
Right now.
conversations?
That's wild.
And so Howard invested in gold. Obviously, he did all right, but nowhere near as well as his son, who was quite anti-gold.
He is, and this quote, I love this quote from Warren. He said, "Gold gets dug out of the ground in Africa or someplace. Then we melt it down, dig another hole, bury it again, and pay people to stand around guarding it. It has no utility. Anyone watching from Mars would be scratching their head." And it is weird when you think about it. That is exactly what happens.
Because if you were to say, okay, why are we doing it? Well, maybe it's scarce. It's scarcity, and therefore it holds value. But there are more scarce precious metals that we didn't choose.
Yes.
You could say maybe because it's got utility. Maybe because we use it in technological applications to make phones and the like, and we use it in jewelry. But there are more useful precious metals. There are precious metals that are more widely used. And then you might say, well, it's historical. It's because we use gold as currency. But again, we used other precious metals as currency. We used plenty of other things as currencies. Back in the day, we used shells as currency. The historical nature of it doesn't
Give it the right.
fully answer the question. But for some reason, as a society, we hold gold above all other possible stores of value. And it's not just even as a society, it's as a world, like across countries, across religions, across languages, across political systems. We can't agree on much. Maybe this might be the only thing that we all agree on, which is that gold is valuable.
Yeah.
It is truly a historical anomaly.
Yeah. So That kind of leads to the next part of the gold story, which has to start with its price. And it's had a phenomenal 2024 as well, setting record high after record high after record high.
But we're not here to talk about the last year. We're here to talk about long-term store of value. So let's define one term that's important for this conversation, a troy ounce. Different to an ounce, a troy ounce is used to measure gold. It's about 31.1 grams. An ounce is 28.5 grams, 28.35 grams. Not going to be important, but just if you ever come across the term troy ounce when you're looking at gold, now you know. So in 1900, 1 troy ounce of gold was worth $20.68 US.
Yeah.
Today, $2,884 US.
So what does that work out at?
Well, that works out to be 4.03% a year.
Okay, not bad.
So, not bad. The question then becomes, how does that compare against inflation?
Yeah.
So, if you go on if you look at the Bureau of Labor Statistics, and we look at US inflation, $20.68 US in 1900 today is $776.99. So that works out to be 2.94% a year.
So it's done what people say it is meant to do.
Yeah.
It's meant to be a store of value and a hedge against inflation.
Yes.
And retain that buying power.
But there is a wrinkle.
Okay.
Because it hasn't been linear. 1971 is the year that really gold hits an inflection point. Now, for people who are students of history, they may know that was the year that Nixon takes the US off the gold standard. Before then, except for a few little historical times where they deviated from the gold standard, US currency, and really currency around the world, was redeemable for the precious metal.
Yeah.
But Nixon changed that. Between 1900 and 1971, gold went from $20.68 to $40.80, which is a less than 1% compound annual growth rate in 71 years, 0.96% a year. But then, from 1971 to today, it goes from $40.80 to $2,884.
Wow.
In 54 years, which works out to be 8.2% compound annual growth rate.
Shackles were off. But that's the starting point. That is always the starting point for gold. As I said, it's seen as a hedge against inflation. The numbers show that it's a hedge against inflation. And I guess this is one of its superpowers.
Yeah, well, as we start to devalue the dollar, you can see that real hedge really kick in.
So let's then move to unpacking some of the superpowers that are driving the gold price. And I guess the question starts with, why did it emerge as a hedge against inflation?
Yeah.
Because to your point, there were plenty of other metals to choose from, plenty of other scarce resources. So why is it ingrained in our thinking and in the theory books that it is a hedge?
Yeah, well, I think the starting point is it emerged as a hedge against inflation because we were coming off the gold standard. So that was the that was seen as, I guess, hard money or real money, and it was seen that taking the dollar off the gold standard and the pound and everything, all currencies really off the gold standard, was devaluing them and making them paper currencies, and therefore people just resorted back to owning gold. So that was the first one. It was kind of just what was. It was like, what was at that time. Yeah. Then there's also reasons why gold is a good store of value, aside from its hedge against inflation. It's globally accepted as a store of value, so you can transport it around the world. It was portable, and obviously, you can't. It's an argument for Bitcoin that it's more portable than gold, but gold is portable. Yeah. You can put it on a ship or put it on a plane and take it from place to place. You can wear it in jewelry and flee somewhere and have that asset then be taken wherever you end up. And so in that sense, it gave the holders and owners of gold independence. They couldn't be subject to the whims of a ruler or a political system, or more recently, perhaps a central bank. So that was always an attractive feature of gold. And then finally, there's this idea of reflexivity, which George Soros made famous, but it was like markets respond to how markets are acting. And because gold acted as a hedge, people saw it as a hedge.
Yeah.
So it continues to be a hedge.
Yeah, it's
I
a
think
hedge because everyone says it's a hedge.
Yeah. And, you know, like as in some ways unsatisfying as that answer is, it is the reason. It's not like you can point to an industrial application or you can point to like jewelry consumption and say that is the reason that gold's such a good store of value.
Yeah. So Ren, for some of those same reasons that you just mentioned, it could be said that silver should be doing just as well as gold.
And you'll get a lot of silver bugs who say that you should be investing in silver, not gold.
Yeah, silver, But that doesn't come through when you compare the performance of silver over the same period of time. So in 1975, silver was $4 an ounce. You bring that forward to today, 2025, silver is $32 an ounce. So over 50-year period, that's an annual compound rate of 3.9%. And if we go back and compare that to the 8.2% that gold has done, pretty significant outperformance.
Yeah. And the irony is that silver has more applications than gold.
Yeah.
It's arguably, like the reason that so many people believe in silver is because there is a rational argument to make that silver should be valued more than gold. But again, it's this group consensus over what is a better store of value that seems to emerge.
It's wild. It's so irrational.
An imperfect analogy would be Bitcoin and Ethereum.
Yes.
Bitcoin is the store of value and it doesn't have a lot of utility outside of being a store of value. Whereas Ethereum has all of these applications, smart contracts, DeFi, all this stuff. But as an asset class, it is underperformed. And there's a lot of Ethereum bulls out there that will say it should outperform. But it's just like, again, if as there's a consensus over one thing being a store of value, that's where people want to store their value. And therefore, that becomes the best store of value.
Yeah. Well, speaking of, for that reason, we have individual investors, we have large corporates, we have institutions, we have governments, central banks, all now buying gold as a store of value. Which then, I guess, leads to the discussion around the impact that has on the supply and demand dynamics because whilst we don't know, well, we may know, I actually don't know if we know exactly how much gold there is on the planet. It is somewhat a finite resource, but with a huge amount of supply from all of these people buying, it is another reason why the price movement has been what it has been.
Yeah. Central banks hold more than 35,000 metric tons of gold. Which is about a fifth of all the gold ever mined. And they just keep buying, especially Russia and China trying to buy a lot. The Europeans, I think, have slowed down, but governments still put a lot of weight in it. Trump's going to try and monetize the asset side of the of the government's balance sheet, which basically means he wants to earn a return on the gold that the US government owns. TBC, what happens there? Elon Musk has already said he wants to audit Fort Knox, which is where America's gold is held. So.
Oh, really? I did not know that. It's at Fort Knox.
Yeah.
Wow.
So there you go. That's why people always try and break.
Have you ever actually seen in real life gold bar? Picked one up?
No.
Yeah, I haven't either.
No. This is the most gold I've probably ever had
in
my life. Yeah. All right. Well, look, let's take a break here. That's sort of the history of gold, but that isn't really what we're asking in 2025. What we're asking is gold a good investment from today? So let's take a break and answer that question.
This series wouldn't be possible without the support from Superhero.
Superhero Super is a low-fee, award-winning super fund. With a wide range of investment options and the flex to invest directly into ASX-listed shares, ETFs, and more, Superhero Super is primed for performance. Superhero also won the 2024 Excellent Rates and Fees and Best for Direct Investment Awards by WeMoney Superannuation.
Now remember, Superhero does not provide financial advice, so consider whether their product is right for you. Read their PDS and TMD and download the Superhero app at superhero.com.au. Interests in Superhero Super are issued by Diversa Trustees Limited as trustee of One Super. Superhero Super is a subplan of One Super.
All right, welcome back to Sidekick. We are talking about one of the world's largest asset classes, and that is gold. We've spoken about how gold has built this consensus around it being the store of value. The question is, what happens next? So, Bryce, what does happen next?
Well, I think we should start by saying that based on historics, there's no reason any of what we just spoke about should change. Like, its perception as a store of value is always going to be there. And because of that, the demand side is going to be there. So I think like the drivers are going to be pretty consistent. Whether or not that's going to, lead to 40% growth year on year, not sure. But I think globally, we should expect that there shouldn't be too much change from the drivers of the gold price.
Yeah, it's basically like as the US dollar keeps debasing, and we're really speaking about US dollars here because it is the global reserve currency. It's the price that gold is priced in, and that's why it's often spoken about that gold and the US dollar have an inverse relationship. And so if you look at the key drivers of where the US dollar is going to go, really it does seem is only going to go in one direction. It's got a unsustainable level of government debt. Interest payments on government debt is now, I think, the fourth largest line item on the US government's budget. We're about to see a $4.5 trillion tax cut package, which will be paired with about $1.5 trillion in spending cuts, which will only add more to the debt, which will only be more inflationary, which will only continue to debase the currency. And here's the economic history for you. Countries that have debt crises, so think about like Greece in our lifetime, but countries who don't have debt crises if their debt is priced in their own currency because they can just print their way out of it. It's only when you're reliant on a foreign currency. Argentina was raising US dollar denominated debt. Greece was raising euro denominated debt. When you don't control the currency, that's when you can have debt crises. If you think about it in the case of America, they can print their way out of a debt crisis by devaluing their currency. But it is going to mean that people are going to be fleeing for hard assets. And in that, obviously we don't want to make predictions here, but like you'd look at the economic setup and you would say nothing indicates that gold's march is going to slow down over the long term. Yeah.
Well, there are a few other reasons why it might not slow down. Goldman Sachs have released a report indicating they reckon gold will rise 8%, hitting $3,000 an ounce by the end of 2025. And they had three key reasons for that. The first being continued demand from central banks, which we've spoken about. The second one, though, is the impact that ETFs are going to have on the price of gold, especially as US interest rates are expected to be cut. They say that they find gold-backed ETFs rise gradually for a 6-month period as rates occur. And this is because more people are putting money into ETFs that are backed by gold, and by doing so, increasing the demand on the supply of that gold. And then thirdly, Ren, to your point, investors see it as a safe haven and will continue to pile in. So nothing surprising there.
So the question then becomes for investors, if we think there's going to be further inflation and further debasement of the currency, the question is there an alternative really? Gold has been a great store of value for the past 50 years, really, since the world went off the gold standard. That doesn't necessarily mean it will continue to be the best store of value. And the obvious one that first comes to mind that some people will cringe at and some people will be cheering about is Bitcoin.
Yes.
Is Bitcoin has a digital gold replaced physical gold?
In the short lifespan that it's had, like the numbers show that it has done pretty well.
It's certainly done pretty well.
Yeah. It just doesn't have the 4,000 years of history behind it that will, in my opinion, truly replace it. Yeah. But it has very similar characteristics, I would say.
I think that for me, it's like you can't look at it as a store of value because it's so volatile at the moment, and it's acted more like a leveraged growth stock than a long-term store of value.
Yeah.
That's not to say it won't, but for me, that's probably the takeaway at this point in time.
Yes.
Like if you're fleeing US dollars in 2025 and you're putting them in Bitcoin, it could halve.
Yeah, absolutely.
Like a lot of crypto people think it will
absolutely
halve.
Yeah, that's what it's. Yeah.
So then the question becomes, what about some other asset classes? Property has
Yeah.
been a great inflation hedge for
Absolutely.
generations of Australians.
Yeah. Yeah.
Stocks
Yes.
with pricing power.
Yeah. I mean, those are the three key ones for me. Well, two key ones that whenever we speak about how do you protect yourself against inflation, it's real assets, as we've said, property, gold, and then, stocks like Transurban, for example, and these companies that can raise prices in line with inflation and protect themselves. Yeah.
The thing that I always go back to when I think about inflation hedge with my personal portfolio is gold has been great. So 1900 to 2025, 4% a year. Shorten that time horizon, 1970 to 2025, 8% a year. Great. Like if you could compound at 8% a year, you're laughing. But the Australian All Ordinaries with dividends reinvested, 13% a year from 1900 to 2024. So it's outperformed gold. And you might say, well, is that inflation adjusted? And it's like, well, all of these numbers are just absolute returns.
Exactly.
But there was this stock market study done by 3 professors that looked at share market returns from 1900 to 2000, 100 years of stock market returns. It was called Triumph of the Optimists because of how positive it was for people that stayed invested. And the 20th century was pretty volatile. There was a bit going on there. But still, it was the triumph of the optimists because of stock market returns. Inflation adjusted, Australia, I think, was the second best performing stock market in the world. And it was an inflation adjusted 6% a year.
All right.
Yeah.
Yeah. Nice.
And so for me, it is just a reminder that the stock mark's been a pretty good hedge against inflation.
Pretty good, yeah.
We don't talk about it as such, but if companies have pricing power and if share prices are in a currency that's being devalued, as long as the share price is rising faster than the debasement, historically they've stayed ahead.
Yeah. Well, with that said, we can now talk to investing in the stock market. No, kidding. I think we should, the final part to this whole conversation in Ren is how can we actually invest in gold? Because we have put a pretty compelling case forward for why it's historically performed well, whether or not it is likely to at least continue to be an hedge against inflation and I guess have pretty strong price pressures behind it. So there are various ways that you can invest in gold, but 3 key ways for us. There are physical gold ETFs, there are synthetic gold ETFs, and then there are the gold miners, both stocks and ETFs.
Yeah, so let's start with the 2 types of ETFs because in those cases you're looking at investing in the gold price essentially.
Yep.
Our preference is for physical gold ETFs over synthetic gold ETFs just because it's physically backed by gold. In some case, like if you're buying units of the ETF, they'll be buying gold and putting it in a vault. A lot of it lives in the JP Morgan vault in London. And some ETFs, not all, but some, you can even redeem your ETF units for physical gold if you want to.
We should try and do that.
I would imagine you need a certain level, but we could try. It would be fun.
Yeah, can we have our gold bar, please?
Yeah.
We can go into the vault.
And so it just means that, like if your units are redeemable for actual gold, if there's any problem with the ETF issuer, they're backed by the actual asset.
Yeah.
What it also can mean is there's less ETF tracking error because if you're just investing in synthetics and just trying to track the price, potentially if it's trying to track price day to day, over the long term you might get beta slippage, volatility decay, but essentially there just might be a little bit of divergence between the short-term price movements and the long-term price movement. That's why we prefer physical gold ETFs.
And there are 4 that we like in Australia listed on the ASX. There's the Global X Physical Gold. The ticker is GOLD. There's the BetaShares Gold Bullion ETF. It is currency hedged. The ticker is QAU. There's the VanEck Gold Bullion ETF. The ticker is NUG, NUGG. And the Perth Mint Gold ETF, PM Gold, is the ticker. So 4 there for you to go and have a look at.
And then the question becomes gold miners. Now, these are companies that are obviously leveraged, they're obviously tied to the gold price, but they're leveraged to the gold price as well in the sense that when the gold price is going up, they will generally go up further than the gold price. Similarly, if the gold price is going down, they will fall further than the gold price. And so a lot of people prefer that exposure to the gold price because they want that additional juice, I guess.
Yeah.
But you've just got to be mindful that there are things that can go wrong in the companies that will be completely unrelated to the gold price. They could
Management issues.
Yeah. They could choose a bad place to mine.
poor
They
test
could just manage
Run
their
out of
capital
money.
poorly and
Yeah.
have too much debt and stuff like that. And so there's just like idiosyncratic company risks that could go wrong.
Yeah.
Similarly, if you get a good management team that gets a good ore body and that can mine effectively, there's things that can go great as
Yeah.
well.
Yeah.
So you can also find gold miner ETFs, and then you can also find junior gold miner ETFs, which are like
high
the
risk.
riskiest of the risk.
Yes.
But to my mind, if you want to invest in gold, invest in gold.
Yeah.
If you want to invest in stocks and companies,
Yeah.
invest in companies.
Yeah. Two different strategies for me there.
And two different parts of your portfolio
Yeah.
playing different roles.
Absolutely.
Yeah.
Well, I guess to close then, Ren, after all of that, do you have any gold in your portfolio?
I used to. And I remember one of the first live shows we did down in Melbourne.
Yes.
I think you and the rest of the panel laughed at me for having gold in the portfolio, but I don't anymore. There's so many ways to make money in the stock market, and like gold has been a great investment for a while, and so I would have no problem with it in my portfolio. But I just think about the inflation hedge that stocks have been, and I'm comfortable enough with that. And then for me, it's like, I just want to optimize for growth. So at this stage in my life, I don't, but that's not a statement on the asset class.
Yeah. No.
What about you?
I'm the same. I don't have it, and that's because I have somewhat of a hedge against inflation. Similar to you, we both have property, and a fair chunk of total net worth is in that. And then also, for me, it's like I have limited resources to put to work in the markets, and I find that the returns I'm getting in the equity market at the moment are more appealing than what I would get if I was in gold. So not to say I don't appreciate what the role gold can play in a portfolio, but I don't have any.
Yeah. So we're more Warren Buffett than Howard Buffett.
Yes.
But if Howard Buffett was alive today, his portfolio would be looking pretty good because gold has been an asset class with a superpower and staying power.
Well, that brings us to the end of today's episode. If you're interested to learn more about how to grow your wealth like a superhero, head to superhero.com.au/registration.
And make sure you subscribe to Sidekick wherever you're watching or listening to this right now so you don't miss an episode. But that's it from us, your trusty sidekicks. We'll be back uncovering more superpowers next episode.